Honestly, this number is one number. It's a quarterly number. I think you're going to take all 4 quarters, you're going to add them up, you're going to divide by 4, and you're looking at a high 2s to a low 3 number. It's kind of okay. You know, you sit there and look at it, and what didn't surprise me is what happened with consumption. Quite frankly, what concerns me is what's going to happen in 19 and 20 in the economy. I think the expectations are going to come in lower than where GDP forecasts are, and I think that's what's reflected in the yield curve. Quite frankly, when the economy is at full employment and consumption is the main driver of GDP, it's really hard to grow that consumption function when you're already at full employment. Combine that with a more aggressive Fed, with the short end of the yield curve high, we just see GDP growth into 19 and into 20 at sort of in that high 1%, low 2% range. We certainly don't see a recession, but we see it very difficult to invest in assets kind of at all-time highs at those kind of multiples when you're seeing GDP growth that's more of a 2% number, not a 3.5%, 4% number.
Well, you said 3, and you say that's okay. If we could do 3 this year, next year, the year after, and the year after that, that'd be a heck of a lot more than okay. Maybe we can. That's more than 50% higher than what we got used to being told was the new normal.
Well, that's right. But what we're saying is I believe by the time we get out to 2019 and 2020, you know, we're going to average under 2% growth. I certainly, again, don't see a recession. But when you see growth stocks getting run up to big numbers, we're not going to have multiple expansion. You got to focus on companies. You got to focus on sectors and assets that can grow NOI. The only way that you're going to get appreciation is to find stocks in sectors where you can grow fundamentals, you can grow the income, and that's what's going to create equity valuation. So, you know, listen, we've preferred hard assets, we prefer value over growth, and we think that's where the opportunity lies because we don't see, again, that 3% number. We see that number moving back to a 2% handle. Again, not a recession, again, not terrible, but not the kind of growth that you would expect to see the stock market continue to run at the double-digit return numbers.
Why are we going back to 2? If we can do 2% with an administration that's not very business-friendly, that has so much regulation, layer after layer of new regulation, that raised taxes, that didn't cut corporate taxes, and we can do 2%, why, when we do all that other stuff, are we immediately going back to 2% in your view? Why is that just a given for you? Because of the same old 2 things, productivity and population growth? Or?
Well, you know, it's sort of not the same old thing. It's just that the economy's been running hot for a long time. And again, the consumer makes up about 70%.
What do you mean the economy's been running hot for a long time? It's been below 3% for 8. It's been below 2% for 8 years.
It's been growing. It's been growing since the recession for a long time. It's one of the longest recoveries.
One of the most tepid.
That's right, and that's what we predicted. In fact, going back a long term, because of what was going on in the labor market, we actually, you know, economists like shapes, whether it was a V or a U or an L, we actually came up with the idea that it was going to look like the end of a gravy spot. It was going to be a long recovery, but a slow recovery, and that's largely what we see. We saw 1 quarter with a 4% sort of number in it that jumped it up. 3% this year, that's good. It's kind of backward looking. We got all the benefits of the tax reform.
Were you predicting, did you think we'd do a year of 3%, or were you arguing we wouldn't do it even this year?
No, we thought we'd have a strong number. We thought we'd be somewhere sort of right, exactly where the numbers are going to come in, kind of at the 2.8 to 3.2% number, and that's largely where we're going to be by the time we get to the year end.